Good morning, dear business partners, and thank you for joining our corporate governance webinar today. So the majority of attendees are on the line and we are ready to start. Let me introduce some housekeeping instructions. All participants will be muted for better quality of audio. You can ask the questions via the Q&A panel on the right-hand side of your WebEx screen, submitting to all panelists. We will conduct the Q&A panel at the end of the webinar. The webinar will be recorded and the presentation will be shared with all attendees. So today we will discuss the regulatory risks boards need to know to make decisions. We will discuss how regional companies have to deal with D&O liabilities and coverage the boards should have to mitigate their decision-making risks. Let me introduce the speakers today. So Dr. Ashraf Gamal Eldin, CEO, Hawkamah Institute for Corporate Governance, Mark Beswetherick, partner from Clyde and CO, Philip Hobson, head of Financial Alliance AAG GCC North Africa and Sub-Saharan Africa, and Jessica Malkahi, senior underwriter from AAG MEA Limited. So with that, I pass the word to Dr. Ashraf.
Hear me? Good morning, everyone. Can you hear me? Okay. Good morning, everyone. Thank you so much for joining us. My name is Ashraf Gamal Eldin. I am the CEO of Hawkamah. We are a corporate governance institute at Dubai International Financial Center, the DIFC. Hawkamah, for those who don't know us, we have been working in the MENA region since 2006 in the area of corporate governance, where we work very closely with the regulators, governments of the region in the area of developing codes of corporate governance, regulations for corporate governance, and also we work with clients directly, and we train directors and boards in the region. So we have extensive experience in the MENA region. So generally speaking, when we talk about boards of directors as responsible for companies, they really have four key functions they are in charge with. We define governance the same definition as which by Sir Adrian Cadbury, which is actually a system by which companies are directed and controlled. So in that respect, it's not just about control, it's about direction. So the foresight of the company, the purpose, vision, mission, values, ethical standards, that's all part of the board's responsibility. Strategy as well, thinking of the future, the long term, what's going to happen in the coming few years. That's a major part of the role of the board of directors. And then, of course, supervision of the company to make sure that things are happening the way they should be happening. And then accountability, holding the management accountable at the end of the day. So this is really the key concept of governance, the way we look at it. And with that, it goes far beyond compliance. So it's not really about ticking the box that we are doing something. It's really about all these elements being integrated into a holistic system for the company end of the day. And of course, the board of directors is the one who is in charge of governance. They are actually the highest authority in the company, which have to make sure that things are being done in the right way. In that respect, they do have what we call the fiduciary duties in this oversight of the organization or the company and making sure that it is actually doing the right thing. Now, three key things actually when we talk about rules of the board and what duties that they have. So three things that you have to pay attention to as directors. Number one, the duty of care. Duty of care simply means that you are a director, a board member, you have to make sure that you are putting all the efforts you need to put in order to make a proper decision. This includes that you have to have all the information, you have to have all the time. If something goes wrong, you have to be able to prove that you have been doing your best in making certain decisions. So if you are discussing a major investment decision, for example, or a major strategy decision, you have to be well-informed, comfortable that you have enough information so that you can make the right decision end of the day. Second duty is actually duty of loyalty, which means that in your action as a board member, you have to be loyal to the company. Unfortunately, this is something which is very confused in the minds of many directors, that they are more loyal to the shareholders who elected them or who appointed them to the board than to the company itself. In other words, we have seen many cases where a board member will vote on something or make a proposition, not because he or she thinks it's the best for the company, but because it's actually the shareholder desire that he or she would like to have this decided by the board. So this is a big problem, because your loyalty, end of the day, is to the company itself and not to the shareholder who elected you or appointed you, which is, again, it's a major difference sometimes. Now, some people have had the concept that maybe, you know, the interest of the company is the same as the shareholder. Not always. Many cases we have seen before where there are conflicts between a specific shareholder and the company. So whatever is good for the company is not really the best for the shareholder in certain deals, especially in related party transactions, and when the company is dealing with that shareholder in another capacity, maybe he is somewhere else in one of the companies or the banks or whatever. And the third duty, actually, duty of good faith, which means whatever you are doing it in good faith for the sake of the company, and you are not having any sort of insider objectives or things you'd like to achieve for yourself. You are, end of the day, serving the company in the best possible way that you are trying. Now, if you look at the main region where actually this is our expertise in, you will see these duties and liabilities of directors, they are covered in so many different places in the same countries. And this is a challenging part. If you are trying to cover this element in one of the countries, you will have to look at different places, not just in one place. So, for example, the most common, of course, place where you find articles about duties of directors and responsibilities of directors will be on companies law. So if you look at the company law in any country in the region, there is a coverage of liability of directors in every company law. However, sometimes we have civil codes in some countries, such as in Oman and the UAE, for example. That's, again, you'll see some parts covered in these civil codes. Central banks, in most of the countries, they are regulators separate from capital market authorities. So you'll find also clauses which focus on directors' duties and liabilities for the banking sector and sometimes for the financial sector, not just the banking sector. Capital market laws, again, in some countries, you will see that they cover these elements. And of course, codes of corporate governance, in most of the countries, they talk a lot about directors' liabilities. However, in some countries, these codes are not binding codes. They're just guiding principles for directors so that they can pay attention to. And in listing rules in most of the countries, you'll find clauses about directors' liabilities and responsibilities as well. So if you are joining a board in the region or any of these countries, you will have to look in these different places to make sure what is it that you are liable for and what is expected from you as a director at the end of the day. Now, what you'll find in these different laws and codes and so on, two different types of clauses, if you like. Some of them will cover you as an individual director. So it will tell you as a director what is expected from you. For example, in the area of conflict of interest, what is conflict of interest? In your case, as a director, how to deal with that, ways to disclose this information, for example. Competition, if you are a board member or you are affiliated with competing entities or some sort of perceived competition between, you know, your positions in these two different entities. When it comes to dealing with loans, for example, dealing with loans to the company in which you are a board member, cases of fraud, abuse of power, insider trading, and all that stuff. So you'll find some rules or laws or clauses which are covering as an individual. And that's sort of very clear and very specific, if you like. However, you have another set which covers you as part of the board. So that's the collective responsibility of the board, of course. Now, based on the best practice in corporate governance, the entire board is liable for the decisions that they make as a board of directors. So, for example, disclosures about board practices, what's happening on the board, disagreements, things about market manipulation and perceived violation of laws and regulations, compliance, all these elements, it's actually a board responsibility. That's where sometimes it gets a little bit blurry and vague, and you might need some sort of legal advice on that respect. Now, just the final slide on this, there are some few issues that, based on what I just mentioned, you have to pay attention to. What is it that you have to be doing? Number one, you have to stay on top of things. Top of things means that you have always to have enough information. You cannot, you know, say, I didn't know about this, or I have no idea about that, or, you know, I didn't find time to study this. No, you have to stay on top of things. You are liable at the end of the day because of your fiduciary duty, and it is your responsibility to get the information, to get the discussions going, to have all the reports, to get all the experts' advice that you can use, so that you have all the information there. So the concept of I had no idea about that, I didn't know about this. So for example, if you are discussing a major investment decision for the company, or a major loan if you are in a bank, or a major strategic redirection of the company, if you do this like in 10 minutes in the board, this means that most probably actually have not done your duty of care. A major decision means major information, means major discussions, means long time of discussions, means experts from outside. You have to make sure that's actually done. And that's, again, that's your responsibility. Second thing you have to pay attention to is you have to stay critical. In that respect, it just simply means that, okay, you are as a sounding board, you support the CO, which is very good, but then you have to question the information you are getting. So you get an information, you get a report, you get some sort of recommendations, you have to be able to question that. Not to question in a negative sense, but in the sense of getting more information. And if you like, sometimes even you can play the devil's advocate to say, okay, what if this happens? Now you have this investment. Now, what if that thing happens, for example? So you have to always to be critical in that respect. And then you have to be true to your values. Now, the reason why you were elected as a board member or appointed as a board member in one of the companies is simply because of your values, your ethics, your background, your experience, your knowledge. You should not change that. So you have to be committed to whatever values you have, because that's why you're elected or selected or appointed in that specific board. So really, it's very important, because it's about trust. It's about your own reputation. So that's why you are always saying that, for example, in case if you feel that you are not comfortable or you don't have enough information, don't then vote or don't decide, or even sometimes in certain cases you might even have maybe to quit the board or to resign from the board in some cases. Final thing is you have to be prepared, meaning that you get the folder, you get the information about certain topics, you get the board binder, you have to read this very well, you have to raise questions, you have to ask for more information, you have to come to the board meeting prepared. Now, we found out that some board members, they are too busy, so actually they don't read the folder, and they go to the meeting not prepared, and so they make decisions which might not be the best decisions that could have been made. Now, all these things, if something goes wrong, it will show that you did not actually do your job well. You haven't really done your part in that respect. And so you have to be prepared, you have to read, you have to ask information, you have to feel comfortable before you decide on something. Again, I try to make it very brief. Of course, I'm open, waiting for the questions, but then thank you so much. And then I'll hand back to Mark so that he can continue on the presentation.
Hi, can everyone hear me? My name is Mark Bestweatherek. I'm a partner in the civil disputes team at Clyde and CO in Dubai. I've been in Dubai about 12 years, and a big part of what I do is working with insurers and companies in relation to directors and officers' claims. So what I thought I'd do, rather than try and run through specific case studies, which would be quite time-consuming, was just pull together some of the themes that I've seen in terms of D&O claims that we've seen over the last 10 to 12 years in my time in the region. So that's basically in 5 different areas. Got 5 slides to run through, and I'll get to the 5th slide if I have time. But really, to think about lessons learned since the global financial crisis in terms of D&O's exposures, just pull together those because I think there are comparisons in terms of the economic consequences of the situation that companies face now, the impact for directors with what happened in 2008, 2009. And then talk a little bit about civil liability, regulatory and criminal risks, because I think when people talk about D&O exposures, they classically think about directors' duties and liabilities and civil liabilities being the starting point. But in my experience, it's often the regulatory risk, which has the ability to deprive someone of their future livelihood, or the criminal risk that has the ability to deprive someone of their liberty that actually keeps the directors and officers awake at night. So I'll cover those in turn, and if we get time, I'll talk a bit about COVID-19 and some of the current challenges that might have. So in terms of the lessons since the financial crisis, I think that the interesting one is that while a focus on domestic legislation and obligations is important, it's often the international exposures that cause the greatest pressure and concerns for individual directors and officers. And I think that's amply demonstrated by some of the recent examples we've seen in the international financial press, to name a Barrage, an NMC, Travelex, and others, which relate to issues in this region. But going back to 2008, 2009, if you just took one example of the Gosabi dispute and the fallout between them in 2009, as everyone knows, that's led to a decade or more of litigation between the various groups as well as their creditor banks in dozens of jurisdictions around the world. And in fact, it's still ongoing. But on the D&O side, just to take the example, there were many D&O claims arising out of that situation as well. But just to take the example of one particular D&O to give you an example of the risks that an individual faces, one of the senior executive directors at one of the Bahrain banks, he was subject to criminal complaints in Bahrain, which included travel bans as well as criminal complaints in Saudi, regulatory investigations by the Central Bank of Bahrain, and then also, following his return to the US, civil claim for recovery for breach of duties, which totaled hundreds of millions of dollars. And so that's pretty typical of the experience of lots of D&Os, particularly in times where you get massive corporate scandals, that they will face all three lines of attack at once or broadly similar in time where those major corporate scandals arise. Another common feature of financial disruption caused by the global financial crisis, or now potentially even COVID-19, is the restructuring and senior management changes. This leads to the arrival of new management who are not always just focused on the future, but can also sometimes be focused on demonstrating their value by unpicking the past decisions of outgoing executive directors and past management teams. And this itself has led to a significant number of claims around the region in the last decade or so. The next point in relation to waning influence is another noticeable trend in this region, and one that I've seen in a number of claims, is that D&Os have not taken adequate steps to protect themselves against their personal exposures, whether through indemnities or insurance, because of overconfidence in the strength of their historic relationships with shareholders, or the trust in their relationships with senior directors and management. In effect, they're relying on relationships as a means to navigate any troubles that they think might arise. But in my experience, there are few relationships so strong as to survive these major corporate scandals, and there are in fact many examples of influential individuals later falling out of favour and occasionally even becoming scapegoats for perceived failings within companies. In terms of insolvency, I mean, globally, the insolvency of companies is a key driver of civil claims against D&Os. We didn't see that trend follow quite so much after the global financial crisis in this region, largely, I think, because at the time, the onshore UAE insolvency laws were relatively undeveloped. For example, in the UAE, in the financial free zone, such as the DIFC, there were some claims, but not a significant number. But during this downturn, I think that risk has shifted. I think the risk for claims against directors and officers of insolvent companies is higher, as the company and insolvency legislation and regimes is now much clearer. And there's certainly an increased willingness to scrutinise the conduct of directors and officers of insolvent companies, as well as a much more sophisticated body of specialist insolvency practitioners to carry out the functions of winding up companies. In terms of indemnities from the companies can be of use in some jurisdictions where they're not prohibited by law, for example, in the UAE. And I've seen a number of cases where indemnities to D&Os have been given informally, and I think practically speaking, they should be clearly defined and reduced in writing to where possible, rather than relying on informal indemnity agreements with the company. But more generally, they're also not a panacea. It's also worth bearing in mind that often indemnities are called upon by individual D&Os where they're no longer working with the company, and therefore it's fairly common, and I've seen many examples of companies refusing to honour those indemnities later in the day for reasons such as their own insolvency or inability to pay, the company actually becoming the claimant in certain circumstances against those former directors, in which case they're very unlikely to indemnify, or occasionally just a flat and unexplained refusal to pay. Moving on then to think about civil liability exposures, and I pose the question, what is mismanagement? Depending on the type of company of which you're a director, which jurisdiction or free zone you're operating in, and whether you have an executive or non-executive role, you'll owe a wide range of both general and specific duties, as Dr. Ashraf touched upon in his presentation. In practice, the most common claims we see involve allegations of breaches of a range of those duties, combined with the general allegation of mismanagement. The term mismanagement is not clearly defined and obviously overlaps significantly with some of those more general duties that directors owe. Now, directors obviously make decisions every day that with hindsight they would not have made, and so this simply reflects their attempts to make rational strategic judgments with often limited information. Now, in my experience, the courts do not make findings commonly in those cases for mismanagement, and won't seek to revisit every single decision that directors have made simply because it later becomes clear that the right decision has not been made or has led to losses. It requires some objective basis for asserting that the decisions made were not reasonable or breached specific duties at the time they were made. But that said, because mismanagement is not a clear concept, we do see some unusual decisions. To give you an example, we dealt with a D&O claim against the former directors of an insolvent company, which was brought by a bank which had lent £10 million to that company, which was upheld by a borrowing court on the basis that the directors and officers hadn't done enough to make sure the company was giving adequate security for the loan it was giving, and therefore the directors were found individually, jointly and severally liable to repay the loan to the bank as a creditor of an insolvent company. So you do get these occasional difficult decisions. In terms of sources of shareholder claims, globally, shareholder claims are again the largest source of claims against D&Os, and that's probably also true in this region. And the legislation provides for broad potential liabilities to third parties in this region, including shareholders. And in recent years, there's certainly been a trend for disputes between business partners and joint venture shareholders who use claims against D&Os as a proxy for their own disputes. So, for example, if two joint venture partners have a falling out, they could seek to resolve that under their contractual, i.e. shareholders or joint ventures agreement. However, for tactical reasons, it's common to see parties bringing court claims against the directors of the party against whom they have a dispute, alleging that they're not exercising their duties independently, are favouring majority shareholders or unfairly prejudicing the minority shareholders. And those actions may have little merit, but they can be quite difficult to defend and have significant leverage for those parties. In terms of working at outside entities, it's also worth noting that claims involving directors and officers working for outside entities are more common in this region. So an outside entity claim would typically be a claim where director and officers are asked to sit on a board or in a senior executive role of a company in another jurisdiction so that the employer can protect its interests as a shareholder or a JV partner in that entity. And that trend for more outside entity claims may be connected with UAE's role as a hub for the wider Middle East and Africa region and the fact that directors tend to sit on many outside entity boards. But it's certainly the case that that's more risky because those directors tend to have less knowledge of those jurisdictions. In terms of the regulatory landscape, one of the challenges for directors and officers in this region, that I think is often overlooked, is the complexity of the various regulatory regimes in which we work. And because of the size of the individual markets in the global terms, it's common for large businesses to view the GCC or MENA as one region. This may make practical sense, but there's no one-size-fits-all approach to operating in the GCC. So this slide that's just come up on the screen is a summary of the challenging environment that companies and their D&Os must navigate between the regulated onshore environments and the often parallel common law regimes that have a very different approach to regulation, to directors' duties and the court systems in which any disputes against directors would ultimately be resolved. And there's now much more overlap between onshore regimes and those in the financial centres as the lines between those jurisdictions become blurred. And I think the DFSA recent disciplinary action against Abraj is a good example of that. In terms of individual accountability, there's definitely been a shift by regional regulators, particularly in the financial centres like the DIFC, towards greater individual accountability in recent years, as regulators realise that changing culture within institutions is virtually impossible without also holding individuals to account as well. So we typically now see regulatory actions against firms also leading simultaneously or shortly afterwards to personal actions against the directors or senior individuals involved in the misconduct. This focus in financial centres is not restricted to individuals performing regulated roles and activities or senior teams, such as CEOs, SEOs and CFOs. It's also common to see individual directors having to account not just for their own conduct and decisions, but also for the conduct of the executive teams, where the regulator deems that the directors have ultimate responsibility for failings within the business. So to give you an example, something which is fairly common, both the DFSA and the QFC regimes attach personal liability to any person, including a director who's knowingly concerned in regulatory breaches. Now, this requires knowledge of the breaches, which may come through board minutes, through being involved in day-to-day operations, or even just being copied into emails in which those underlying problems come to light and not having seen them properly resolved. And in terms of the involvement, again, is a very broad concept and can include involvement by directors and senior managers who merely have directorial or managerial responsibility for the department or the conduct in question. But the point to note is that the regulators often take a much more expansive view of the director's knowledge and involvement in these matters and in regulatory breaches than one might expect. And challenging that assumption for directors can be quite difficult. And just finally, moving on to criminal risks. I mean, corporate fraud and corruption scandals remain a major source of risk and liability for directors in this region. Although the UAE scores highly on the Transparency International Corruption Perceptions Index as a low-risk jurisdiction, the UAE's role as a management hub for the wider region means that directors are often responsible for operations in some of the world's highest risk jurisdictions in that index across the Middle East and Africa. In terms of high-profile corporate frauds, we all know about the examples of Abraj, NMC, and Finabler, and the allegations that have been made there, which are still ongoing. But there's also a broader range of scandals globally that have a connection with this region, including operations through Unaoil, through the Nissan scandal and Carlos Ghosn, and the recent Barclays SFO prosecutions in relation to the Qatari funding in 2008, all of which, in one way or another, have a connection to this region. The media tends to focus on the high-profile individuals, but it's often the case that many others will get dragged into the fallout, ranging from board directors and officers, C-suite executives, and individuals performing compliance functions, as the regulators and prosecution authorities get to the bottom of how the frauds occurred, who's involved, and how the entities fail to spot and prevent them. And finally, just one other point as well, is that it's much more common in this region than other regions for criminal actions to be used as a tactical ploy against directors. So third-party business partners, shareholders, creditors can instigate criminal complaints as a tactical ploy in order to increase their leverage in support of civil claims, which they might be bringing for losses suffered or just to put pressure on the adverse party. And often those investigations don't proceed very far beyond the referral to prosecution authorities, but they can be particularly concerning for DNOs to have to deal with, as well as very expensive. And just the last point in relation to DNO's personal risks, this region also has some oddities in terms of the personal risks that directors and officers can be taking on. So everyone's aware of the personal potential liability for criminal prosecutions of general managers of businesses, particularly in areas like health and safety. There's also personal liabilities for DNOs in areas like signatories of checks that a company is later unable to honour. And also, in relation to criminal fines and penalties, there are risks of travel bans. And we dealt with a recent example of a director of an international engineering company who was subject to a travel ban purely for being involved in a defects claim relating to a high-profile infrastructure project in Qatar, and that was used very much as leverage to try and resolve the civil issues as well. So these issues are always overlapping in terms of directors' liabilities, and the criminal matters can often be just as concerning as the regulatory and civil claims as well. So I'll stop there because I'm conscious of time and that I've run on for 15 minutes. So I'm happy to pick up any questions at the end. And now I'll pass over to Jessica, who's going to talk about the insurance solutions.
Thank you, Mark. Well, good morning, everyone, and thank you for joining our discussion on D&O liability insurance in the current market. I'm Jessica Mulcahy, and I've been with AIG now almost a year. Prior to that, I was working in the London market as a PI underwriter. And today, I would like to discuss a few key points with you. Firstly, we're going to look at exactly what D&O insurance is, and then some general misconceptions which come with that. And then we'll move on to understanding the duties of a director and officer, which should lead us onto a brief look at increased exposures in the current market. And then finally, why you should consider AIG as your D&O insurance partner. So let's begin with discussing what D&O liability insurance actually is. So here I've got some basic definitions. Directors and officers insurance provides indemnities to directors and officers for legal costs, damages, and expenses incurred which arise from claims brought against them personally due to wrongful acts. In this situation, a wrongful act is defined as an actual or alleged act, error or omission by an insured person. This can include negligence, default, breach of trust, breach of duty, and misrepresentation of insureds in their capacity as directors and officers and managers. When considering a D&O's potential liability, there are quite a lot of misconceptions about what this actually is. Some of these misconceptions include thinking that directors have limited liability, or that if you don't have the director or officer title, then you can't be held liable. Well, these are all false. And as a D&O, you could receive a lawsuit in which you could be responsible for paying legal costs, expenses, and even damages. Seeing as no prudent director or officer wants to risk personal significant damages, it is imperative that you have appropriate cover in place. This leads us onto our next slide, in which we'll discuss key coverage points. So, what do you actually get when you purchase D&O policy? D&O policy. Our quote here states, D&O insures directors and officers against hostile actions by third parties. These can be the regulators, administrators, or indeed by their own company. It pays for external counsel fees to defend a director or officer in such actions, as well as damage awards and settlements, as long as no fraudulent behavior is established against them. Below this, we have also highlighted a few key coverage points. As mentioned, claims include costs and expenses or damages where legal, and you also have investigation costs. These are extremely important as at AIG across Europe and the Middle East. The top 20 highest payments made by AIG for D&O claims against directors total to over 400 million euros, which is an average roughly of around 20 to 30 million euros per claim, which is quite a significant amount. Along with this, defense costs in regulatory or criminal matters are increasing in the current climate. Another key point to consider is D&O claims can go on for a very long time, as I'm sure Mark will know. Years in some cases, particularly regulatory claims or fraud investigations. These can be very stressful and very expensive. I would like to highlight, as previously mentioned, it may not just be directors who face actions and investigations. Sometimes claimants can take a very broad approach to naming people, and it can be quite a shock to more junior managers or supervisors to be faced with such actions, especially as the financial amounts claimed can be very high. With this said, I think it's important to now consider some of the key duties of a director or officer on the next slide. So, as we've previously discussed in the presentation, the board have duties to the stakeholders. These are shareholders, regulators, legislators, and employees, and these duties revolve around a duty of care and loyalty. They need to ensure that they are always acting in the best interest of the company and exercising reasonable care where possible. These duties are made more complex with the ongoing changes to the global economic and local regulatory environments. And these are key exposures that I'd like to discuss a little bit more further on the next slide. Right. So, directors' exposures have been highlighted by a much tougher legal environment since the global financial crisis, with more regulation, more scrutiny, and more claims against directors. These also involve companies of all sizes, and in fact, a good proportion of our claims are for private companies and not public, which I think a lot of people find interesting. I'd also like to state that this also includes a high amount of more SME to mid-sized businesses, so it doesn't necessarily require that you are a large entity to be to have an exposure. The current state of the global economy is quite similar, if not worse, perhaps, to the global recession of 2008, and I think this really poses an imminent risk and thus increases the exposures for key decision makers within a business. When we look at the Middle East specifically, we have seen a strong growth of liability risks within the region. This is due to various reasons ranging from shifts in societal trends to risk perception. And for instance, we've seen the region become more litigious in recent years, which is directly impacted by a high amount of regulatory enforcement activity in the region. Though all exposures mentioned on the slide in my diagram are significant, I would really like to highlight a couple which I think are really important. These are the insolvency exposure, derivative actions, duty of disclosure, and the much discussed cyber risk. Insolvency risks are particularly high during a global downturn. These tend to lead to a surge in bankruptcy cases brought about by various stakeholders. What I'd like to do is, in order to illustrate, is to talk through a claim scenario, which I hope will kind of make it more relatable to everyone. So here we have, in this situation, the applicant company, they owed money for goods supplied to other suppliers when they went into liquidation. The supplier then sought an order to examine their records, which were in possession of the liquidator. These records showed that for several months prior to declaring insolvency, the applicant company was not reaching its break-even point. In this case, the court ultimately found that the company had incurred debts when the directors should have had reasonable cause to expect that the company would not be able to pay those debts as and when they fell due. The court found the directors personally liable for a sum of 1.5 million AED. This is a really good example of why, when we underwrite, we tend to want to understand or have a good understanding of how the insured is able to service their debts and meet liabilities, especially in the current market. Along with this insolvency risk, we have also seen a sharp rise in derivative actions, and this is not just in the Middle East, this is across EMEA. This is where a shareholder brings a lawsuit on behalf of the company against the D&O. They usually arise from a breach of fiduciary duty or loyalty. This is quite an unusual trend as well. Anywhere outside of the US, we tend to see this more in the US than anywhere, which is an interesting movement in the market. The amounts of these claims can be quite significant, and as such, we tend to see them more with the large FIs. The next key exposure is the duty of disclosure. This is an increased exposure in the current market, and a good illustration, again, I have in order to help it be more understandable, is the board of directors at an investment holding company was summoned to answer alleged violations of the capital markets regulation, which is enforced by the capital markets regulator. The complaint alleged that the board did not disclose in due time an important acquisition to the market. As per market regulation, directors are required to disclose any information which may have an impact on both the value of shares and investment decisions of investors. The chairman and other board members were found guilty and had to pay 500,000 AED in fines due to their lack of disclosure. Again, when we underwrite, this is why we look to ensure that our insurers have a good relationship with the local regulator and are constantly in communication, especially during times which are slightly unprecedented and might mean that decisions are being made which have never been made before. And then finally, we look at cyber risks. So cyber has grown significantly over the years to the point where it's now a key board consideration. In fact, cyber risks could have material impacts on companies, for instance, the valuation of a company. Therefore, it's really important that we encourage all directors to make this a key boardroom consideration. And this moves on to us onto our final point. Why choose AIG to partner with D&O Insurance? So on my final slide, I've got a couple of points here which just highlight AIG, as many of you will already know, has multiple key offerings, which includes a broad policy wording. We've got local presence, which is essential in addressing client needs. We have underwriters in the UAE who write business on both a reinsurance and a direct basis. This allows us to service all businesses across the GCC in North Africa, and especially our multinational clients. We have established ourselves as global market leaders in D&O insurance, not only from a coverage and service point of view, but our claims experience and claims handling capabilities are exceptional. And as mentioned previously, we have managed a significant amount of D&O claims across EMEA and across the world, hence adding to our experience. So I really think that there's not a lot that we haven't seen. And with that, I'd like to say thank you for your time today, and we will now move on to our Q&A session, which Irena will moderate.
Jessica and all speakers. So we have several questions online, and the first question comes to Dr. Ashraf. So the question, you talked a lot about staying on top, and the question is about exactly that. What if a director is not able to access information or information is being blocked by the management? Is he still liable for that?
Well, actually, this is a very interesting question because we have heard this a lot from some board members who say, how can you hold me liable for something which, I didn't actually know? The financial statements came out, and how would I know actually these are not the right numbers? And in some cases in the region, we have seen major destruction of value because of manipulation of financial statements by management sometimes. So to put things back into perspective, the board is in charge of the company. So even the codes of the region, they say the company is managed by a board of directors. So in fact, the board is the ultimate authority in the company itself. Now, as a board member and as a board collectively, we have to make sure that we are getting the information. Now, if you look at the responsibilities of the board, the first thing is the selection of the CEO, evaluation of the CEO, and dismissal of the CEO as well. So if I am a board member, or if we are as a board, we are not getting enough information from the management, or if we feel that there is some sort of manipulation of information which is happening by the management, we have to step in and we have to do something about it. Because like the case of Mobile in Saudi Arabia, which is, I think it's even still ongoing case right now, which happened almost 6 years ago. Up till now, still the board is, I think, held liable, and they are still in different lawsuits and stuff like that. Nobody hears that much about the management, but actually it's the board itself. So what I'm trying to say is, yes, you are still liable because it's your duty to get that information. If you as a board cannot get this information, this means the management is not the right management and something is being cooked there. Now, how to make sure even that this information is accurate? It's very simple. You have to follow the system. So you have to have independent internal auditor, for example, who reports to you as a board. So I have to make sure that we have the right internal audit system in the company, and that system is effective. I have to have a strong audit committee, which has both financial as well as technical expertise in the company operation and company field, so that they are in charge of that. And I have to make sure that we are getting the right information through the right channels. And eventually also we advise boards that you must establish a good whistleblowing system. So yes, you have your internal audit, yes, you have audit committee, but then maybe something will go unnoticed, but somebody in the company or maybe the suppliers can see it. Then they have to have a channel to report back to the audit committee or the board saying something is wrong in this case. So yes, you are still liable in the corporate governance sense. Yes, you are, because that's your responsibility and you have to stay on top of things.
Thank you, Dr. Ashraf, for your extended answer. So the next question to Mark. Please advise some details of the Gosabi. What is the takeaway from that?
Yeah, it was interesting because I think I gave you one example. There are actually a number of D&O claims in relation to the Gosabi matter. I mean, the takeaway, the point I was trying to get across was really that that individual fell from grace quite quickly and went from being a very senior executive director within a bank, although he wasn't the only one. I just picked him as an example. Went from being that very senior individual, influential, well thought of, to overnight being held responsible for a lot of the failings within the bank in relation to the alleged loans that had been granted and alleged involvement in the wider fraud. And so when you take an individual like that, all of a sudden they've lost their kind of standing, they've lost their job. There were regulatory investigations against them where they had to respond to. There was a criminal investigation both in Saudi and in Bahrain, and then ultimately that individual was a US citizen and went back to the US and faced civil action as well. So you've got a massive attack on an individual. They're no longer involved in the company. They can't turn to the company for assistance or indemnities, for example, because that may not be lawful, or the company may not be willing to indemnify them anyway at that stage. So that person is then all of a sudden faced with huge amounts of personal liability and also personal cost, because even though the majority of these claims disappeared and actually did disappear ultimately, in the sense that none of those claims were successful, the defense costs involved and the investigation costs involved in responding to those allegations are incredibly expensive, as well as Jessica mentioned, as the stress and the time involved. Because these investigations and claims can run on for years. So ultimately, that's a good example of quickly things can shift and how extensive an individual's exposures can be. And if you're stuck in this region, uninsured, unindemnified, with facing lots of these different claims and unable to travel, then you're in a pretty invidious position.
Thank you, Mark. So next question to Philip. Can you comment on the current state of the D&O market?
Thank you, Irina. Yes, I can. I mean, I must say that the D&O market has done a 180-degree in the last 24 months. We are now in what's called a hard market, where there's typically increase in premiums, reduced availability of capacity, and narrowing of terms and conditions. So, you know, if I look back after the financial crisis, which was really the last hard market we had, generally there was a reduction in pricing, a large availability of capacity, and widening terms and conditions. And that existed for the last decade, I'd say, up until the last 24 months. And what brought this change about, right? I mean, it is really that, you know, a sustained period of, you know, underwriting losses on D&O portfolios. And that generally came about, you know, in a few areas. So, you know, US listed D&O has over a number of years been unprofitable for insurers. And even to some degree, private company D&O actually, private company tends to be quite a, you know, lower rated type of business and you know, lower risk for us, given that it's not listed. But the premiums that were attributable to this line of business were not enough to cover the development in the claims. And the claims really developed in a number of areas. You know, I think that you can have a change in legislation overnight. You know, some economic shocks that can drive some of the insolvency claims. You know, regulatory oversight that really digs into director conduct. And so a lot of things can happen that can sort of, you know, lead to increased claims on a portfolio. I think the good thing, I suppose, is that generally, if you go by past history, the hard market cycle is a shorter period than the soft market cycle. However, the increases in a hard market are more pronounced than, you know, a gradual reduction in the soft market. So, yeah, current economic, the current state of the D&O market is seeing increasing in claims. And when I say increasing, you know, there've been a number of reports that have come out that you're looking at generally an average, you know, of up to 50% increase on a portfolio, which means, you know, a significant increase in premiums, reduced availability of capacity, and narrower terms and conditions.
Interesting one. Thank you, Philip. Next question to Dr. Ashraf. How can a director act if the chairman of the board is not supportive to various directors' requests for clarifications or time to discuss strategic matters?
Unfortunately, actually, I've seen this some cases where directors complain that you know, we raise these points, concerns in the board meetings. We raise the concern that we are not able to get enough information. There is a major point of discussion or a major project which is being discussed, but we don't really get information from the management. Unfortunately, in certain cases where, again, remember what I said in my presentation, actually it's about reputation and the values of the director himself or herself. So we always say that, look, as a director, the key thing you have is really your reputation and your image. So if you are not able to get that information, if you feel that the chairman is doesn't really care for governance. I mean, we have seen boards where some chairmen are maybe quite old in age and they are not really into governance, transparency, and disclosure and all that stuff. They are very old school kind of people. Now, the key point is this. I mean, for us, this is like a disaster in the making, which means eventually you will have a problem in this company, you'll have a major disaster in this company. So if you are not able to convince other board members and the chairman that we need this information, then it's either that if you talk about a specific decision that you are discussing, then you actually abstain from that, or even you reject that decision. So you have to mean it that you refuse that decision. Or if it is a general thing, which is in all the cases, then you need to resign and leave that board immediately. Because again, eventually a disaster will happen, and your name will be there as part of the group that caused or allowed this disaster to happen in the company itself.
Thank you. The next question is to Philip. It's more on the product side. So how does one determine the limit of insurance to purchase?
Yeah, this is a question that all buyers of insurance have to face at some stage, right? So maybe just a step back, I mean, if you think of the policy and what it covers, Jessica elaborated a bit on it, but it's really covering the defense of an allegation against a director, as well as any judgment settlement, found against the director. So when considering the limit, bear in mind that you've got to fund the defense, right? And typically this is a substantial portion of the payout. The court cases and the litigation can take, over a number of years through various stages in the court process. So, bear in mind that the legal costs can be, in some cases, as much as the actual damage or settlement amount, right? The other thing is an important consideration of affordability, right? So, it really depends on what the company's ability is to pay for the premium, and affordability is a big concern around that. And so they, if one has engaged a broker of reputable standing, they should be able to benchmark your company against others, and you can, through the benchmarking exercise, get a feel of what sort of limit one should be purchasing. But bear in mind that what's going to draw down that limit, and also the affordability of the company. Thank you.
Thank you, Philip. A question to Jessica. Are insured versus insured claims covered?
Hi. Generally, under our policies, we would look to exclude insured versus insured claims. This is just primarily because it discourages infighting among senior management and removes the comfort blanket, I guess, of having an insurer's backing. It also removes any incentive for sort of collusive behavior, and avoids that there is no, unlawful behavior generally. So no, generally it's not.
Okay. Can the insured select the law firm to defend their claims?
Another good question. Typically, we would want our preferred law firms to handle the claims. We have, as AIG, we have a panel of law firms, Clyde being one of them who's on this panel. They are experienced, they have the necessary know-how, and have done this before, representing a director against an allegation against him. But we do recognize that there may be situations where a particular insured would prefer to use their own counsel. We would agree to it on an exception basis and only through our agreement. And one would have to demonstrate that there's something particular that this counsel can bring, and that they have the necessary expertise, to deal with a D&O claim. So we don't actually see a lot of this situation. I think generally, our panel stands up, and given that they have vast amounts of experience, generally our insureds are happy with them. But if there is unique circumstances, we can agree to use an insured's preferred counsel.
Good, thank you. Question to Jessica. Is an innocent director or officer covered for claims related to criminal acts by other directors and officers?
Yeah, good question. Of course, every claim is different, and every claim will have its own circumstance. So it's really hard to put a definitive answer on that. However, what I will say is that generally, innocent directors would be covered for their D&O insurance policy, even if the acts of the co-defendants were intentional, criminal, or fraudulent, unless we then later discover fraud further down the line. So yeah, we'll always look to cover the initial investigation costs.
Thank you. And the final question to Dr. Ashraf. If the management gives the board false information, then how can the board be responsible for that?
Again, it's actually a claim that we hear a lot from board members. I recall one of the board members that in a training session for them, when we talk about exactly this topic, they were saying that you mean that if the CFO is manipulating data and giving us false information, we are liable. How can we be liable for this? It's simple. They are liable for this because they have to make sure that all the right checks and balances are in place. Which means, for example, in many cases, actually the boards can even select the CFO of the company and can make sure that they have direct access to him or to her. Again, they are the ones to have the internal system in place. Are we auditing on this CFO or not? Do we have a strong independent internal audit? Because in many cases, we have seen internal auditors who are actually not independent. They have some other jobs or they report to the management and so on. And we have seen audit committees which don't even have a single financial expert. So if I have an audit committee in the board and none of them can read financial statements, it goes automatically, the CFO can manipulate and do anything for us. So again, as a board, we have to have the right composition of the board, the right people on the board, we have to have the right committees and they have to be functioning properly, and we have to be overseeing the entire process. So one of the key responsibilities of the board is to review the policy procedures all the time. Even we can get external party to do that check for us, because I suspect if AIG, for example, would have a case where a company, somebody manipulated the financial statements, which resulted in a disaster in the company, and if they go in and they find out that in fact the company did not have any internal policies which prevent that, they will, I think, have some question marks on should we actually be covering this or not, because in this case, that's really negligence in that respect. This is really not doing your job as a board. So yes, as a board, you are still liable because it's your job to make sure that the entire system is working perfectly. And that's why I said in my presentation, it's not about box ticking, it's not about compliance, it's about making sure the system is actually working. Not just that we have a system, but actually it is really working in reality.
Thank you very much. With that, I would like to close the webinar. So thank you very much for the speakers and for the attendees. So we have the majority of the attendees still online. Thank you for your attention to this important topic. So we covered all the questions that were submitted online. Thank you very much for all who submitted the questions. As promised, we will share the recording and the presentation with all the attendees. We will have the list of emails by the end of the day, and we'll send it through shortly. Thank you very much for your attention and have a good day.
Thank you. Thank you.
Thank you.
Bye.